Hello, welcome to the Deloitte Dbriefs webcast series in Asia Pacific. Our webcast today is from our corporate income tax series and is titled Pillar 2, Impact on M&A Transactions. My name is Daniel Ho and I'm a tax partner based in Deloitte, Singapore. I lead Deloitte Southeast Asia M&A tax practice and I have the pleasure of hosting today's webcast. Joining me today are distinguished speakers, Wen-Jie Chan, a tax partner based in Deloitte, Singapore as well, David Schutz, a tax partner from Deloitte Australia, and Anthony Stobart, a tax partner all the way from our UK office. You can find our bios on the left side of your screen. Before I introduce the agenda for today's webcast, I would like to take a moment to highlight some of the features of our webcast console. First, all users are on listen-only mode. If you have any content-related questions, you can submit at any time in the Q&A box at the bottom right of the screen. We'll do our best to respond to your questions during the presentation. Second, all PC users can maximize or minimize each box at your convenience during the webcast. You may also explore the icons at the bottom of the screen. If you want to download today's slides and related publications, please go to the Downloads and Links box. On the other hand, mobile device users can view the slides and answer the survey on screen. Thirdly, if you require an attendance record for this event, you will receive an automated email with CPE certificate after watching for 15 minutes. Now let's move on to the agenda. Today, in this webcast session, we will discuss the following topics: due diligence approaches in a Pillar 2 context, Pillar 2 related contractual terms and protections in M&A transaction documents, structuring in the context of Pillar 2, including pre-sale carve-outs, Pillar 2 in joint ownership situations, followed by Q&A. Now let us begin the webcast proper. Before we dive into the different topics, let me just briefly set the scene with a quick update on where we are globally and regionally with respect to Pillar 2 implementation and how this is starting to impact M&A transactions. As of today, we are well into the second wave of implementation. The Income Inclusion Rule and Qualified Domestic Minimum Top-Up Tax Rules, or QDMTT, are already enforced in over 50 jurisdictions, including most of the EU, the UK, Australia, Japan, and Singapore. The Under-Tax Profits Rule have now taken effect in over 25 countries, adding complexity to cross-border tax exposures, and we are expecting further UTPR implementation by end of this year. Many of you, especially our friends in Europe, who have already started on tax provisions or are now preparing for filing of the first IRR or QDMTT returns. And next year, the Group Information Returns, or GIR, will be due by 30th June 2026 for entities with fiscal years ending 31st December. Finally, the Transitional CBCR Safe Harbors, or TCSH, will lapse by end of 2026, and multinational groups will have to start preparing for full globe calculations by FY 2027. So we are not at the starting line anymore. We are in the thick of action. For deal makers, this means that Pillar 2 is no longer a theoretical risk. It is a live issue that affects due diligence, transaction structuring, and contractual protections. So what does the future hold for us? Having looked at where we are today, the next 12 to 24 months will be pivotal as jurisdictions continue to roll out local legislation and issue Pillar 2 guidance. We expect further local country implementations, especially in Asia Pacific, where some jurisdictions are still in consultation phases. This means that deal teams will need to stay alert to jurisdiction-specific rules. This can impact how top-up taxes are calculated, whether QDMTTs apply, and what disclosures are required as part of due diligence. A key area to watch is interaction with the US tax regime, especially in light of the proposed US G7 side-by-side arrangement. This could influence how other jurisdictions apply the IR and UBTR, and whether carve-outs or safe harbors are extended. For cross-border deals involving US parented groups, this could impact whether Pillar 2 exposure is mitigated and whether contractual protections are needed to address that uncertainty. We also anticipate additional OECD guidance, particularly around administrative simplifications and dispute resolution. Updates around deferred tax assets, substance-based exclusions, and safe harbors can directly impact valuation models and risk allocation in transaction documents. From a compliance standpoint, The first globe information return are due by 30th June 26 for fiscal years ending 31st December 24. That's less than a year away for many taxpayers. Going forward, transactions will need to factor in Pillar 2 reporting obligations. The TCSH is another key milestone. Once and if it expires on 31st December 26, companies will need to prepare for full globe calculations without simplified reliefs. This means that buyers and sellers will need to review full globe calculations, which could increase tax diligence complexity and costs. As implementation progresses, we'll gain increased practical experience both in terms of how tax authorities enforce the rules and how deal makers respond. This will help refine market norms around indemnities, escrow arrangements, and insurance coverage. Hopefully, this means that insurance premiums will also go down over time. We're already seeing an evolving market approach to M&A transactions with more deals incorporating standard language to address Pillar 2 concerns. These include representations on globe compliance and warranties around top-up tax exposure, as well as updated diligence checklists. All these developments underscore the importance of integrating Pillar 2 considerations early in the transaction lifecycle. And without further ado, I shall invite Wenjie to take us through the approaches to Pillar 2 due diligence that we have observed so far. Over to you, Wenjie.
Thanks, Daniel. So let's start with our first topic, which is the approach to due diligence. And I'll spend some time talking about why this is a particularly difficult topic. And first, to set the scene, as you'll be aware, the calculations for Pillar 2 are done on a jurisdictional basis. And that's unlike the typical tax due diligence exercise, which is done on an entity-by-entity basis. So given the jurisdictional nature of Pillar 2, this therefore makes due diligence in a Pillar 2 context particularly tricky. But nonetheless, today, I would like to share a three-phase approach that you can see here that we've seen being used in practice. And the caveat here is that, of course, things would evolve as rules and experience develop. But I think this framework gives us a practical way to assess whether Pillar 2 diligence can be done in a meaningful way. So the first phase is really about understanding the nature of the transaction and asking ourselves, can we actually do Pillar 2 diligence in any meaningful way? So on this slide, you'll see three key questions. And if the answer to any of them is yes, then there is a reasonable chance that we can do due diligence. But if the answer to all these questions are no, then it's going to be quite difficult. And we'll likely have to fall back on contractual protection, which my colleagues will talk about later on. So you see on the screen, the first question there is really, are you buying the ultimate parent entity, the UPE? In other words, the whole group. Because in such a case, when you buy the whole group, then you would have visibility over all the entities and the jurisdictions involved. And that makes diligence feasible because there are no retained seller entities, right? But let's take a step further. And let's say, for instance, you are not buying the UPE, but you are only buying part of the group. Then that's when we move to the next question, which is, are we buying all the entities within a certain jurisdiction? And again, if the answer to this is yes, and if let's say Pillar 2 applies in that jurisdiction, then yes, we can see the full Pillar 2 calculation or the jurisdictional return for that country, and we can therefore do diligence on the jurisdictional tax, top-up tax accurately. But again, if the answer is no, meaning we are only buying some of the entities within that jurisdiction, then that's where the challenge may come in. And that is because the seller will be retaining certain entities whose data we cannot access. And that will affect the ability for us to do diligence, since the jurisdictional top-up tax is computed based on the results of both the retained entities and entities which are within the transaction parameter. And then that leads to the third question. Is there relevant information outside of the transaction parameter that we can obtain? Because if the answer to that is no, which means that we can't see the full group or the full jurisdiction, then due diligence in that case is going to be quite difficult. And of course, we can always ask the seller for information about the retained entities, but in reality, that's not something we see sellers are willing to share. So in such cases, full diligence would likely not be possible, and that's when we have to turn to contractual protection. And even in cases whereby due diligence cannot be done, we may still do a limited go-forward analysis to try to understand how the target's profile might blend into our group under Pillar 2. Right? So just to recap, phase 1 is about 3 things, really about defining the transaction scope, assessing the visibility, and really answering these questions here to see whether you can perform meaningful diligence or whether you must rely on contractual protection. All right, so now assuming diligence is possible, we move on to phase 2. And the first question to ask is, we want to do diligence on is whether the transitional CBCR safe harbors, or TCSH in short, may apply to the target group. And the reason for starting with this is because if that particular country passes the TCSH, then the top-up tax in that country automatically is deemed to be zero. So in practice, almost every M&E group would rely on the TCSH to simplify compliance during the early years. And it's also worth reminding everyone that the safe harbors apply on a jurisdiction by jurisdiction. So you may meet the TCSH in one country or another. Okay? Now, assuming that these target entities are in a jurisdiction that passes the TCSH, then there will be a few questions we want to consider in order to validate that position. Firstly, to benefit from the TCSH, the group will require a qualified country-by-country report, a qualified CBCR, or equivalent data. So one of the key things to look at is whether the TCSH is based on such a qualified CBCR. And say, for instance, if the seller is exempt from filing a CBCR, but as long as they can produce data that would have been included in the CBCR, they may still qualify. And secondly, to the extent that the target jurisdiction passes the TCSH, then the question to ask is which one of the 3 tests, the de minimis test, the simplified ETR test, or the routine profits test has been passed. And these come inherently with slightly different levels of risk. For instance, the simplified ETR test requires you to do some minor adjustments as compared to the de minimis test. And next, from a diligence perspective, timing will also be a key limitation. And it's worth remembering that the TCSH relies on full fiscal year data. In other words, you can only test them when the CBCR for the year is complete. So say, for instance, if you are doing a deal now in October 2025, then you can easily check 2024 because the CBCR may likely already exist. So you can run the numbers, you can test the safe harbors and see where the target group stands. But for 2025, you would not have the full year figures yet. So while you can make an educated guess by maybe looking at 2023, 2024, and you can look at whether the group has passed comfortably or narrowly the TCSH, strictly speaking, you can't rely on it from a diligence perspective, and that will be a key limitation. And lastly, as mentioned earlier, large groups would typically use TCSH first, but they would generally have, most of the time, 1 or 2 jurisdictions where safe harbors don't apply. And if so, we will move to phase 3 diligence for these remaining jurisdictions. So on the next slide, you will see under phase 3, this is when safe harbors don't apply, and really when we have to roll up our sleeves and do diligence on the actual detailed group calculations. And that's where really the technical complexity will come to the surface. And on this slide, you will see a few boxes over here. I'll touch on a few of them. And the first one will be on local implementation, which will be a critical diligence area. And now, when Pillar 2 was first introduced, I think many of us assumed that implementation would be binary. Either you have enacted it or you have not enacted it. But in practice, it's not that simple. Because across different jurisdictions, even within the EU, we are seeing variations in which when the charging rules are enforced and when they take effect. There are also other jurisdictions that have implemented only the income inclusion rule, the IRR, and with the QDMTT coming later, for instance, Japan. And for UTPR, that remains the least commonly implemented rule, where several countries haven't even legislated for it at all. Next, from a diligence perspective, it's also important to remember that as of now, really no group returns have been filed as of yet. So for the first year in scope for December 2024 year ends, the first Globe information return isn't due until June 2026. Even if you look at QDMTT returns, even the earliest ones for QDMTT returns for Belgium and Vietnam, those are only due for filing in November and December 2025, respectively. So rather than being able to look at a return, what you have to do would be to review the working papers supporting the Pillar 2 calculations. And what is crucial will be to understand the assumptions, the judgments behind those calculations. For example, what exclusions have been taken out of Globe income, what are the deferred tax adjustments that have been made, and what elections have been made by the target group. Another point to note is also that most countries would require at the minimum a local Globe return to be filed. But in many cases, the central filing of a Globe return, for instance, in the HQ country, should be able to cover the rest of the jurisdictions through information exchange arrangements. However, if there's no information exchange agreement, then local filing obligations can still arise. And this will be compliance and data risks that you need to highlight early in diligence. And lastly, just to close out, we are also seeing a few emerging tricky areas that come up quite frequently. For instance, hybrid ownership structures, the deferred tax adjustments, and incentive regimes. And even if you don't manage to resolve it fully during diligence, this will be something to flag out early in the process as well. Right, so to wrap up, using the three-phase due diligence approach, I think that serves as a useful framework towards thinking about how we can go around deals in a Pillar 2 context. And really 3 steps. Firstly, on scoping and visibility, defining what's being inside the transaction scope, what we can see. And to the extent that diligence is possible, then the next step you want to think about is on the TCSH and the assumptions around that. And last but not least, on the detailed calculations, understanding local implementation, looking at the working papers, and also the technical judgments. So that's the bit for due diligence. I'll pass the time back to Daniel.
Thanks, Wenjie. Now that brings us to the first polling question of the day. And the question is, how do you expect the US G7 side-by-side arrangement to impact cross-border M&A involving US parented groups? Options are, it will simplify deal structuring by reducing Pillar 2 exposure for US groups. It will create uncertainty due to legal and political challenges in the EU. It will encourage other jurisdictions such as China and India to seek similar carve-outs. It will have limited impact, most deals already factor in Pillar 2 risks. Fifth option, too early to tell. And last option, not familiar with the US G7 side-by-side arrangement. While we wait for responses to come in, perhaps I shall now invite David for some comments around and thoughts around the diligence approaches that you have seen in the Australian market. David? David, I think you're on mute.
Perhaps I could answer that, Daniel, just from the EU perspective, whilst David's coming back online. As Wenjie was saying, diligence is actually really hard, and in most cases that I've been involved in, we've had to rely on contractual protection. And the interesting thing that I would say is that in all of the large examples that I've seen, vendors have been willing to give contractual protection for Pillar 2 risks, which is different from many other risks where typically they might not be, or they would be relying on warranty and indemnity insurance. So it's just a brief perspective from the EU perspective.
Thanks, Anthony. And I think the results have come in. And while the majority of respondents say that they are not familiar with the US G7 side-by-side arrangement, So that's something that we probably need to get out there more in the market. And the second, most popular response is too early to tell. So I think there's still a bit of maybe perhaps education needed in terms of this arrangement to carve out US from Pillar 2 rules. So maybe let's move on to the next section. And perhaps, Anthony, I shall hand over to you to talk about some of the contractual terms and protections you have seen in transaction documents. Anthony?
Yes, thank you very much, Daniel. So if we turn to the next slide, we can see the thought process as we get to contractual protections. So as Wenji was saying, in many cases, Pillar 2 cannot be diligence, and that depends on the nature of the transaction. So we need to rely on contractual protection. As I mentioned earlier, a moment ago, I'm seeing that in M&E carve-out situations, seller groups are willing to give contractual protection because they realise that Pillar 2 cannot be effectively diligenced. Then on the right-hand side, two observations on how we actually go about doing that. So existing indemnity wording, we're all familiar with existing contractual protection, and so the question is, can we just squeeze Pillar 2 into that? And for the reasons I'm going to outline in a moment, that might not work. Then in terms of what we're actually seeing, I see a wide variety of approaches, a lot of different drafting from legal firms, and I don't think there's any real settled market practice. There's probably some that's evolving, but I think it's going to take some time for market practice to settle down. And so currently we see some very complicated drafting, we see some very simple drafting, and I'm going to give an example of some drafting that I think is particularly interesting. So if we turn to the next slide, let's look at the existing indemnity and what are the key features of that. So I've set out at the top what I've called the basic approach. And so we just rely on the indemnity and standard indemnity for pre-closing tax liabilities. And that has two key features. So first of all, it would say for all closed periods, seller is responsible for tax. And then for what we call the straddle period, so that's the period, the fiscal year in which the transaction closes, we split that into profits and events and taxes up to the date of closing, and that's for seller's account, and then for profits, taxes and events after closing in that straddle period. That's for purchaser's account. So that's the basic indemnity structure. Now, I've outlined at the bottom three problem areas. There are actually more, but these are three that I want to highlight. And actually, in terms of complexity, the easiest one is on the left and the hardest one is on the right. So conduct. Well, in a normal indemnity, purchaser would have conduct of tax compliance, and then there may be some specific provisions about sharing conduct in relation to tax exposures, but purchaser will have acquired target companies and will deal with tax compliance, tax computations for those companies. There's something very odd about Pillar 2 when an entity leaves one M&E group and joins another one. And the odd fact is that if the departure occurs during a fiscal year, then that company is actually in the seller's group for the entirety of that fiscal year, and also in the purchaser's group for the entirety of the fiscal year. Because joining or being part of an M&E group for Pillar 2 purposes is a characteristic which exists or doesn't for a given fiscal year. There's no concept of a straddle period in that sense in Pillar 2. And so when purchaser acquires a target entity, it will come with an obligation, target entity will come with an obligation to complete its tax returns, its Pillar 2 returns, as a member of seller's group. And there's no way that purchaser can do that. Purchaser can only fill in, complete the tax compliance obligations of targets as a member of purchaser's Pillar 2 group. And it's only seller that can complete that tax compliance. So we need to flip round the conduct provisions to say that where a target joins purchasers Pillar 2 group, it's actually seller who retains all of the Pillar 2 compliance obligations in relation to target as a member of seller's Pillar 2 group. And I've got some drafting for conduct provisions, which I'll show you in a moment. Second point is something called additional current top-up tax. This is actually a feature of Pillar 2, which hasn't been remarked on very much in the literature and guidance. It can arise in actually 6 different ways. The way that I want to just briefly mention now is where you have an adjustment to your adjusted cover tax and effective tax rate in an earlier period, as a result of which there is an additional top-up tax to pay. That additional amount is actually payable and a liability of a later period. So it's not as if you go back and you refile your earlier return, you actually charge that tax in the later period. And so in certain M&A scenarios, you could find that having acquired an interest in an entity, it is exposed to additional top-up tax, and that is very clearly a liability of that later period, and therefore may not be covered by your standard indemnity wording, but it is clearly caused by an earlier period. And you want to make sure that you're protected for that. And then the third item, it's what I've called effective post-closing events. You won't actually see that in the model rules itself. It's just a name that I've invented to try and explain the issue. And if we turn to the next slides, we can see what I hope is a simple illustration of how this arises. So what we're looking at here is seller M&E group in country X selling CE1 also in country X. And let's suppose that closing is, well, let's say today, 23rd of October, and we have a December year end. So we're going to ask a very simple question, which is, what are the ingredients which we need to take into account when calculating top-up tax for CE1? Well, there are 2 key ingredients. First is the income and taxes of CE1, which are consolidated into the seller's consolidated financial statements. And those amounts are consolidated up to the date of closing, which is fine. That's what we'd expect. So far, so good. The second ingredient is results of the seller's group itself in country X. And this is because of what we call jurisdictional blending. Top-up tax is calculated on a jurisdictional basis by aggregating all of the results for a particular jurisdiction, to the extent that those results are reflected in the consolidated financial statements of the UPE, the M&E group. And we can immediately see, I think, that the results of the seller's group in country X, which are consolidated, will be for the entirety of the fiscal year. In other words, not only up to closing, but post-closing as well. So it's only when we take into account all of those profits and taxes up to closing and post-closing for seller's retained M&E group, and just up to closing for CE1. Only then do we know whether there's top-up tax to pay, and if there is, we then calculate the amount. But you can see, I think, that the top-up tax, which would be allocated to CE1, is clearly influenced by and affected by results of seller's M&E group post-closing. And so the standard indemnity wording will not necessarily capture that and protect a purchaser in these situations. So what's the solution? Well, I'm going to show, if we turn to the next slide, an extract from some sample wording which I've seen in a deal which I actually advised on, and I think it's quite elegant, and I think one should consider wording of this nature to guard against the risks that I've identified. I should caveat this: I'm not a legal advisor. Please take your own legal advice in relation to your contractual documents. I should also say that I've just extracted the essence of the wording here. Those little dots you see, they contain other important legal wording, but I'm just trying to show the principle. And the key principle we'll see in the left-hand box there, which I'll just read out briefly. Seller covenants to pay Pillar 2 tax of any group company, so this is a target company, and then we get to the key wording, as a consequence of having been a constituent entity of seller's Pillar 2 group. That's it. So that wording, as a consequence of having been a constituent entity of seller's Pillar 2 group, that captures those risks that I mentioned, because the additional current top-up tax or post-closing events They're all related to having been part of Seller's Pillar 2 group. On the right-hand side, we see something slightly different, but also very important, and wording that we're actually seeing in many scenarios. It's related to something that Eagle-eyed might have spotted on one of Wenji's slides in phase 3 of his diligence outline, where he mentioned, or the slide showed, elections. And in certain implementations of QDMTT, there is a domestic provision which allows an election to be made to allocate the entire QDMTT liability to a single entity. And in an M&E scenario, it may be very useful to allocate that entire liability to a retained seller group, if there is such one. And so we have a covenant that, so far as legally possible, and we might insert their reference to specific elections that can be made under relevant domestic legislation. No Pillar 2 tax shall rise to any member of buyer's group, and this includes target entities which have now become part of buyer's group. And then if we turn to the next slide, I'm going to touch briefly on some conduct provision. And again, I've extracted from some SPAs some specific aspects of conduct which I think are worth bearing in mind. And we've got 5 points, 3 on this slide and 2 on the next. So first of all, the overall approach, the parties agree to cooperate in good faith. Secondly, who has conduct rights? Well, that's what I was mentioning a moment ago. It's seller has conduct rights for Pillar 2 in relation to membership of Seller's Pillar 2 group. Then we have a confidentiality provision. This is very important because jurisdictional blending means that there are many cases where there may be a requirement to disclose or take account of information in retained seller's group, and seller needs to be certain that it won't be required to provide confidential information unless required by law. And then if we turn to the next slide, 2 more points. We have on the left a seller obligation to provide something which we've called a Pillar 2 protocol. And I think anyone who's grapples with the compliance requirements of Pillar 2 will know that the mere task of identifying information and understanding information flows is particularly complex. And so this document would set out conduct and procedures in relation to Pillar 2 compliance and could be extremely useful for a purchaser. And then on the right, we have purchaser's obligation to provide seller with information relating to target documents for Pillar 2 compliance. So that's a brief overview of the contractual protection and contractual wording that we're seeing in practice. And I'll now hand back to Daniel.
Thank you, Anthony. And maybe we'll move on to the next topic, which is quite important, and that relates to deal structuring in a Pillar 2 context. Over to you, David.
Thanks, Daniel. Hope you can all hear me now. Apologies for the technology issue before. So in this section, I wanted to talk about 2 things. Firstly, how Pillar 2 can impact the structure of the deal itself. And then secondly, how Pillar 2 can impact pre-deal carve-outs, as well as other common pre or post-deal reorganizations. So if we move to the first slide, so we'll deal with deal structures first. So in this diagram, we see a standard asset sale transaction. UPE1 sells the assets to UPE2, and the accounting gain arises to UPE1. And let's also assume that UPE1 benefits from a tax exemption for this gain in jurisdiction X. So it might have a specific tax exemption, or it might have fair market value tax base in the assets. And so when we look at the corresponding Pillar 2 exemptions, these can often, outside of selling shares, be much more restrictive, and it's likely that no exemption would be available for the Pillar 2 gain arising here. So in that case, UPE1's effective tax rate would be reduced because we have an accounting gain with no associated tax, and that could ultimately lead to top-up tax. On the other hand, UPE2 will obtain market value basis in the assets for Pillar 2 purposes generally. And so you can see that this is a good answer for UPE2, particularly if it can amortize the asset from this higher basis for Pillar 2 purposes, but potentially problematic for UPE1 UP1. So let's see a potential alternative structure that can give UP1 a better outcome. So if we move to the next slide, please. So this is just a very simple example of enveloping the target assets. So, step one, UP1 sets up a new code, likely in the same jurisdiction, and then step two transfers the target assets to the new code. And this could be structured to qualify for a Pillar 2 neutral globe reorganization, or alternatively, you might do the transaction for book value, so there's no accounting gain, and generally there's no arm's length override for same country transactions. And then in step 3, UP1 transfers the NewCo shares to UP2, and that would be an excluded equity gain for Pillar 2 purposes. So what UP1 has managed to do here is to dispose of the assets, albeit indirectly, with no adverse Pillar 2 consequences. On the other hand, UP2 won't necessarily get a step up to fair market value basis for the assets for Pillar 2 that's acquired. And that's generally the case even if UP2 applies purchase price accounting, such that the assets are stepped up actually in its consolidated financial statements. We'll talk about that later. So we can see that there's a clear preference for UP2 as the acquirer, so that the deal structure is an asset sale, whereas UP1 as the vendor has a clear preference to structure it as a share sale. So obviously an impact on deal structure, negotiations, and potentially purchase price. So that's what I want to talk about on the deal structure. So maybe now we can turn to transactions that might occur pre or even post sale. And we've included a few relatively common transactions and what the likely impact is on both the full globe and safe harbor rules. So if we can move to the next slide, please. So here we'll continue with our example from the previous slide, where UP2 has acquired the new code from UP1, which holds the target assets. And this example now considers a subsequent transfer of those assets around the group. So it might be IP assets you're transferring around to the IP hub location. And this should hopefully bring home the point around the purchase price accounting. So when UP2 acquired NewCo, let's say it applied purchase price accounting and it stepped up the target's assets, the target assets to $1,000, and its book value was 100. So you stepped up by 900. And UP2 now transfers the target assets to existing sub. And let's assume there's no corporate tax arising on that transfer. And it could be because you've stepped up the acquired assets to fair market value for tax purposes, for example, under Australia's tax consolidation regime, or the existing sub might be in the same jurisdiction as NewCo, so it could be a tax neutral transfer in the same jurisdiction. So what you have here is you've got no accounting gain on the disposal due to the purchase price accounting, and no tax on the disposal. So is there a Pillar 2 issue is the question. And as you can see in the table, the answer is yes, potentially. Purchase price accounting generally can't be taken into account for Pillar 2 purposes. There are exceptions, but as a general rule. And again, generally, if it's taken into account for Jurisdiction X's country by country report, then that could disqualify that jurisdiction from the safe harbor altogether. So from both a safe harbor and a full globe perspective, you could recognize a large deemed accounting gain of 900 with no associated covered tax on that transfer. And we've seen this come up a few times on live M&A transactions in Australia. Just in terms of other considerations, obviously, if there was corporation tax payable on the transfer to existing sub, that could be included as a covered tax, so that might alleviate the ETR reduction. Another alternative approach would be to transfer the assets to existing sub for their historic book value, so there's no accounting gain even after you ignore the purchase price accounting. Now, there is a Pillar 2 arm's length override rule that you need to consider in that case, and also if that rule didn't apply, then you kind of keep those assets at its historic book value for Pillar 2 purposes going forward, and that might not be a good answer for amortization purposes. So now if we move to the next slide, please. So now let's change the nature of the assets to shares in another sub, CE3. So again, let's assume that the fair market value of the shares is higher than the book value, and there's an accounting gain on the disposal here of 900 again. And we'll also assume that there's a participation exemption that applies in jurisdiction H for the share sale. So from a full globe perspective, those rules also contain a participation exemption. It's pretty broad in its application, so it generally applies for shareholdings of greater than 10%. So you wouldn't really expect any globe income to arise here. So for full globe rules, there's no globe income and no covered tax, so neutral impact overall. However, there's no equivalent participation regime in the safe harbour, so this could negatively impact your effective tax rate for the safe harbour purposes, even though it's a relatively benign transaction. Now, maybe if we move to the next example, please. And so this is debt waivers. So again, relatively common. We see these pre or post deal. So here CE2 is the borrower under a loan from CE1. CE1 waives the debt, and CE2 has a accounting gain as a result of being released from its liability. Now, in some jurisdictions, the debt waiver can just be entirely tax neutral for the borrower, like in the UK. In other jurisdictions, it's not necessarily tax neutral, but can reduce certain attributes of the borrower, but may or may not give rise to covered tax per se. But if we assume that there's one of these rules applies and there's no tax payable by CE2 to the borrower as a result of the waiver, then in principle we have an adverse ETR impact for both globe and safe harbour purposes, because there's an accounting gain arising in CE2 with no associated covered tax. Now, I should mention that the full rules, but not the safe harbour, does include a special rule for debt releases, whereby you can exclude the accounting gain for Pillar 2 purposes. But it's relatively narrow, and it's broadly limited to kind of genuine distressed situations. So things like waivers occurring as part of insolvency proceedings and the like. So that rule wouldn't really help a waiver that occurs purely as part of a group reorg or simplification around an M&A transaction. So that's all I wanted to cover in this section. I hope it's illustrated the need to really think about the impact of Pillar 2 on, firstly, deal structures, and also on intragroup transactions, even for benign transactions that we may have all done many times in the past, and even in jurisdictions where you might be confident of benefiting from the safe harbour, such as Australia. So with that, I'll hand back to Daniel, I believe.
Yes, thanks, David, for that. So this is time for our second and final polling question. And the question is, where Pillar 2 aspects have come up in the transaction, which aspects do you think are most important to you? First option is tax due diligence. Second option is contractual protections. Third option is allocation of top-up taxes. Fourth option, transaction planning. Fifth option, tax insurance. And last option, Pillar 2 does not concern me. So again, while we wait for results to come in, maybe if I can just bring you in back in, David. I'm not sure whether you mentioned whether there's an issue with Australia tax consolidated groups and hybrid arbitrage arrangement rule within the TCSH. Perhaps you can elaborate on what this issue means and when does it arise?
Yeah, thanks. So it's a really interesting issue that's arisen in Australia due to the nature of tax consolidation in Australia, whereby transactions between members of a consolidated group are just completely ignored, unlike in the UK, for example, where the transaction is kind of regarded, but you kind of just get group relief. And that can cause an issue under the safe harbour, particularly under the hybrid arbitrage rule. And the hybrid arbitrage rule is an anti-avoidance rule. And it applies to intragroup financing transactions where there is an accounting expense, and that expense isn't matched by both accounting income and taxable income on the other side. So if you take the example of a loan between members of a consolidated group in Australia, you would say, well, we've got interest expense in the borrower, and that's matched against accounting income in the lender. But given that the transaction's ignored for Australian tax purposes, there's no taxable income arising. There's also no deduction arising, but that doesn't matter. The point is there's no taxable income arising, so you have a potential issue under the hybrid arbitrage rules. And interestingly, the ATO is aware of this issue, and they have actually in the last day or two released guidance on this issue, and they basically acknowledge that yes, this is a problem under the rules, but they're not going to dedicate compliance resources to it. So for most practical purposes, I suspect this issue has been kind of solved, albeit through a kind of practical compliance approach rather than through a strict technical reading of the rules. But it's a really interesting and topical issue.
Thanks, David. And so the results have come up, and interestingly, majority of responses are quite evenly split between, in terms of issues in a transaction context as regards to Pillar 2. I think it's quite evenly split between tax due diligence aspects, contractual protections, and transaction planning, which are, typically the work streams that we get asked quite a fair bit by clients to help support them, given the nature of these complex and new rules. So hopefully this session will be useful for the audience. And we now can go over to the final topic of today's webcast, which is joint ownership situations, and we'll ask Anthony to take us through this topic. Anthony?
Great, thank you, Daniel. So we're now going to turn our attention to another type of contractual protection. So I covered earlier sale and purchase agreements, which look at the allocation of risk for periods up to closing. And in a jointly owned structure, we will typically have a shareholder agreement, which looks at the allocation of risk and other matters, of course, for future periods. I'm using the word jointly owned structure, or the phrase jointly owned structure, very deliberately. The diagram I'll show you in a moment is what we would typically call a joint venture, but joint venture has a very specific meaning for Pillar 2 purposes, and I'm not considering, at least today, Pillar 2 joint ventures, so I'm going to call them jointly owned structures. And the key message here is ensuring that if you're party to a jointly owned structure, that you are protected against unexpected Pillar 2 charges which can arise. And I'll illustrate that on the next slide. So if we turn to the next slide, we can see a very simple structure with two investors at the top and subsidiaries at the bottom. So let's have a look at what's going on. We have what I've called the UPE, the ultimate parent entity, with a majority ownership stake, here 70% in the jointly owned entity. And we have a co-investor with 30% in the jointly owned entity. And then we've also got some subsidiaries sitting underneath those. So we've got CE1 sitting underneath the UPE, it's a wholly owned subsidiary, and we've got CE2 sitting under the jointly owned entity, again, as a wholly owned subsidiary of that. So that's our setup. Now let's look at this through the Pillar 2 lens. So what is the profile of this for Pillar 2 purposes? Well, first of all, the color coding. So green indicates jurisdiction, a jurisdiction that's implemented Pillar 2, and the specific rule that we're going to look at is the income inclusion rule. And blue represents a jurisdiction which hasn't implemented Pillar 2. So we can see that at the bottom we've got those two entities which are not in Pillar 2 jurisdictions. So we're going to be concerned with the income inclusion rule. Now, we see that UPE owns 70% of the jointly owned entity, so we're going to assume that UPE consolidates that into its M&E group. And that means that there is a single M&E group comprising UPE, the jointly owned entity, CE1 and CE2. And the co-investor, we assume, doesn't consolidate, and therefore it sits outside that. There's another aspect, which is the POPE rules, or the partially owned parent entity rules, that we need to remember. So the fact that the co-investor owns more than 20% of the jointly owned entity means that the income inclusion rule will apply at the level of the jointly owned entity in respect of any interest that it has in other entities. Okay, so that's the Pillar 2 profile, that's the setup. Now, let's look at co-investors' perspective on this scenario. And the scenario that we've shown here is that CE1 is assumed to be low tax, which means that its effective tax rate for Pillar 2 purposes is less than 15%. And CE2 is assumed to be high tax, which means that its effective tax rate is more than 15%. So what does a co-investor see? Well, it looks down at its investment and it sees its jointly owned entity, 30% of that, so it has the economic risks and rewards of that ownership. And then it looks down further and sees that the jointly owned entity has an investment in this case, high tax entity for Pillar 2 purposes. So the co-investor would not expect to suffer any economic effect of any Pillar 2 top-up tax. But what happens in reality? Well, let's assume that when we aggregate the results of CE1 and CE2, CE1 being low tax for Pillar 2 purposes, that the aggregate position is that there is top-up tax to pay. How is that allocated? Well, for the income inclusion rule, that top-up tax is allocated on the basis of globe income. So you take the top-up tax and you allocate part to CE1 based on CE1's globe income and part to CE2 based on CE2's globe income. And having done that allocation, you then apply the income inclusion rule charge. And to the extent that top-up tax has been allocated to CE2, it's the jointly owned entity that actually has to pay that top-up tax under the income inclusion rule because it's a partially owned parent entity. And part of the top-up tax allocated to CE1 and then chargeable on the UPE. And the co-investor may feel that it's been treated unfairly because it's suffered the economic cost through its 30% interest in the jointly owned entity of that top-up tax. Whereas it's very clear when we look at this that the entire top-up tax has been caused by CE1, which the co-investor has no economic interest in. So the result is that the co-investor should ask the UPE for an indemnity in respect of any unexpected top-up tax, which it can suffer the economic benefit of or economic cost of. This diagram shows the co-investor being prejudiced. On the next diagram, we flip round the position of CE1 and CE2 and make CE1 high tax and CE2 low tax. And exactly the opposite can happen, and it can be the UPE that's prejudiced. So the UPE may then ask the co-investor to indemnify it, UPE, against any unexpected top-up tax that might be allocated to it. And if we turn to the next slide, we can see the outline of how the indemnities might work. And a potential solution is to compare the top-up tax payable on a notional standalone basis for the jointly owned entity or for the UPE, compared with the actual position where the jointly owned entity is part of the UPE's Pillar 2 group. And if there's more top-up tax allocated to CE2, then the UPE will compensate the co-investor. And if, contrariwise, the UPE pays more top-up tax than on a standalone basis, then the co-investor compensates the UPE. So I will now hand back to Daniel for the Q&A.
Thank you, Anthony. And I think we do have some time for Q&A, and I'm just looking through the questions that have come through. First question, maybe perhaps for Anthony, since the UK and European markets are probably more developed in respect of Pillar 2. The question is, what are we seeing in the tax insurance market? Can Pillar 2 risk be insured?
Yeah, that's a great question, and it's something that is coming up more and more. So the very simple answer is broadly no. So there are two types of insurance that we need to think about in the M&A context. One is W&I, or warranty and indemnity insurance, and the other is specific tax risk insurance. So currently, all W&I policies, at least the ones that I've seen, and I've spoken to a number of brokers about this as well, and this reflects their experience as well. W&I policies have a standard exclusion for Pillar 2 taxes. I've seen, I'm aware of a very small number of cases where that exclusion has been waived, and therefore W&I policies have included Pillar 2, but those have been in sort of trivial situations where the entities aren't in the scope of Pillar 2. So really hasn't been a meaningful provision of any insurance. On the second type of insurance, specific tax risk insurance, I'm actually only aware of one single example where relatively straightforward Pillar 2 risk was being insured, and underwriters were willing to quote. I don't believe that the insurance policy was actually taken out, but it does show that at least in some cases it might be possible to get specific tax risk insurance. That position, I think, particularly on W&I, is going to evolve, but we're certainly not there yet at all.
Thanks, Anthony, for that. And maybe moving on to a second question. In Asia, we have a few jurisdictions that does not tax capital gains. For example, Singapore, which has the safe harbor rule, which was very useful in the context of deals. I think the question is probably asking around the Section 13W tax exemption in Singapore. How will Pillar 2 affect this? Maybe that's a question for Wen-Jie. Would you have comments on this?
Yep, sure. And actually, I think David did touch about this earlier, but maybe not so specific in the context of Section 13W. So it's absolutely right to say that Pillar 2 will have impact on transactions, and David has alluded to that in quite a bit of detail earlier. And where there's been no corporate income tax in the past based on domestic tax rules, for instance, Section 13W, you might start seeing some impact from a Pillar 2 perspective. So and it also depends on what the asset in this case will be. So using Singapore as an example, and let's say if like the question alluded to, if you're disposing shares in Singapore, then from a Singapore corporate income tax perspective, you have Section 13W, which is the safe harbor rule. You have the capital gains argument. So you might not see a corporate income tax exposure. But from a Pillar 2 perspective, that result might change, although you may still achieve the same result if you can qualify it as an excluded equity gain. But if the asset you're talking about is not shares, but instead assets, then from a corporate income tax perspective, this may be capital in nature, therefore not taxable in Singapore. But from Pillar 2 perspective, you may still have top-up tax unless you can qualify for certain elections, or you can structure it into a globe reorganization, or as David mentioned earlier, if you transfer it at no gain, no loss. So you do a contribution, or do a dividend in specie. So it really depends, and the position between corporate income tax and Pillar 2 may or may not be the same.
Thanks, Wen-Jie. And perhaps one more question. The question is, I think, Anthony, you have mentioned in the earlier discussion that vendors have been willing to give contractual protections covering Pillar 2 risks. Would this include both strategic and financial vendors, such as PE funds, or only strategic vendors?
Yeah, that's a really, really interesting question. It actually takes us back to the very beginning of the presentation and the phase 1 of the approach to diligence that Wen-Jie outlined. The structure of most PE groups from a Pillar 2 perspective is that they don't consolidate their portfolio investments, and therefore, because Pillar 2 depends on consolidated financial statements, typically a portfolio investment by PE will be a standalone Pillar 2 group. And therefore, when we're doing diligence on a portfolio investment, generally we would expect actually to have full visibility over the entirety of the group, and therefore we would expect to be able to do diligence. And it's really only in the carve-out scenario that we need to rely on contractual protection. So generally I would not expect PE to be willing to give contractual protection, but there's a very good reason, and that is that we would, or they would, expect that diligence can actually be done.
Okay, thanks, Anthony, for that. And that unfortunately is all we have time for today. Thank you, Wenjie, David, and Anthony, and special thanks to all of you who were able to join us. We would like to encourage you to fill out the short survey that will pop up on your screen and tell us what you think about today's program. If you join us late, please note that this presentation will be archived for future viewing. If you feel that others would benefit from this webcast, please share the webcast via the share this icon or have them visit the Dbriefs website. We will respond to all the questions submitted during the webcast in a couple of weeks. Also, if you think of any other questions or comments later, please feel free to reach out either to myself or our speakers. We'll be more than happy to speak to you. And join us on 30th November, where we would have another webcast on supply chain resilience in high tariff world and best practices. You can visit the Dbriefs homepage for more details. Lastly, from all of us at Deloitte, thank you for your participation in today's webcast. Thank you and goodbye.